Okay, we're now going to take a look at exercise 15.5. Still dealing with the same set of information. It's just here manufacturer Southern is going to lease their equipment directly from International Machines, the group that the company that sold the equipment to Edison Leasing in exercises 15.4 and 15.3. So this is going to be a sales type lease, and we're going to look at it from the vantage point of the lessor, in this case International Machines. So what's happening here, remember with Edison Leasing, the only way they earned revenue on that transaction was through interest. They paid $112,080 to International Machines, and then they leased it out to manufacturer Southern, and they earned their revenue as interest revenue on that transaction. Now here, manufacturer Southern has really kind of cut Edison Leasing out of the deal. This would be the situation if they went straight to International Machines and did the lease for the equipment, which again, since the lease term is 2 years and the useful life of the asset is 2 years, remember it qualifies as a capital lease. So our lessor here, though, International Machines, is going to earn revenue two ways. They're going to earn, remember the cost, let's read through it. Manufacturer Southern leased high-tech electronic equipment from International Machines on January 1st, 2016. International Machines manufactured the equipment at a cost of $85,000. Note the fair value of the assets, $112,080. So they're going to make that gross profit from $112,080 minus the $85,000. They're going to earn that much gross profit, and they're also going to earn this interest revenue. Okay, so this is the lease that's called a sales type lease. Now remember, they're calling them a lease, but these capital leases are essentially a purchase. In requirement 1, they want us to show how International Machines determined $15,000 should be the quarterly rental payment. Well, what they did there, they took the fair value, $112,080, and they're going to divide that by a factor from our table. Remember, these payments are made at the beginning or received by International Machines at the beginning of each quarter. So we're in their equal payments over time. So we're dealing with an annuity due, and we want its present value factor. Well, it's 8% interest for a year, so 2% every quarter. And we're dealing with 8 periods here. So our factor was 7 point. We're going to the table present value of an annuity due. That's on the very last page of your textbook, P-6. And we come across to 2% and down to 8 periods. That's 7.47199. We're going to divide the fair value of the asset by that, 7.47199. And that's going to bring us to our quarterly interest payment amount. And that's how that would have been calculated. Now on requirement 2, they ask us prepare the appropriate journal entries for International Machines, the lessor in this case, to record the lease at its inception on January 1, 2016, and the second rental payment on April 1st, 2016. Again, you guys, I kept the same amortization schedule because it didn't change. But note how this one's different. Dealing with 2016 and January 1st. Okay, first, International Machines was debit lease receivable for the fair value of what they are of the equipment that they're selling to manufacturer Southern. That's $112,080. And they're going to credit Not equipment this time. Not in this entry at least, because that's not the $112,080 is their price they're selling it for, not their cost. So we're going to credit. Maybe I gave it away already, but sales, or I think your book says sales revenue. Either one would be fine. $112,080. Okay, now your textbook combined this into one entry. I think it's easier to handle in two, but also on January 1st, we would debit cost of goods sold. For the cost to International Machines, which was $85,000. Then we're going to credit, you probably guessed it already, inventory of equipment. And it comes off the books at its cost, $85,000. So here, International Machines, technically the lessor, they're going to make this spread $15,000 plus $12,080, so $27,080. They're making that much in gross profit. And then over the 2 years, they're also going to earn this interest revenue. Okay, so they want us to make the April 1st, 2016 entry. Well, you guys, you should be accustomed to this by now. We'll just go to our April 1st row here. Oh, but we're not quite there yet, though, right? We didn't take care of the January 1st payment that was received. Sorry, I'm trying to get ahead of myself there. Remember, on our amortization schedule, the first entry we would need to make would be for January 1st. Okay, so International Machines received $15,000, and that's going to decrease the balance in lease receivable. So they'll debit cash for $15,000 and credit lease receivable for $15,000. All right, now that takes care of the January 1st entries. Same as what you saw before, except this entry was made for $85,000, the cost to International Machines. And they recorded some sales here. Really, on the previous, the direct financing one, they just debited lease receivable for the $112,080 and credited inventory for the same amount, because that's what Edison Leasing paid for it, right? That's not what International Machines paid for it. They're earning revenue here two ways. Okay, now they want the April 1st entry, which you've seen several times, or at least you saw it in the last problem. They're going to debit cash, the amount of the payment received on April 1st, which was $15,000. They're going to credit lease interest revenue. It doesn't matter which of your credits you list first. You could have listed lease receivable first. But I just kind of like going across our chart here. Our interest revenue was $1,942. And then we'll credit lease receivable for the difference in the two, $15,000 minus the interest portion. It's $13,058, which should match right here. And that's all they asked for on this one, you guys. Now, they'd carry the entries out as well. The only place you really see a difference in the direct financing lease and the sales type lease is right here. Okay. Good luck with that one. I don't think you'll have any trouble with the exercise 15.5 on Connect Plus after working this one with me. And if you have any questions, please be in touch. Thanks.